So picture this, it's 2021. Everyone around me is making thousands overnight trading meme coins and NFTs. My group chat is flooded with screenshots of portfolio gains. And there's me, quietly putting $500 into VTI every single month like some kind of investing dinosaur. My buddy Jake literally said, "Dude, you're watching the revolution happen from the sidelines." Fast forward to today, Jake's down 70%, crypto winter hit hard, and yesterday he texted me, "How do I start investing again?" Here's the thing, nobody tells you about staying boring when everyone else is getting rich quick. Let's set the stage properly because context matters here. The year is 2021, and the investment world has gone absolutely insane. It's not just that people are making money, it's that they're making life-changing amounts of money in time frames that seem to defy everything traditional finance ever taught. Social media is flooded with gain screenshots. Reddit communities are moving markets. Teenagers are becoming millionaires. The entire script of how wealth is built appears to have been rewritten overnight. In the middle of this chaos, there's Jake. Jake is 28 years old, works a regular corporate job, making about $70,000 annually, and he's got this strategy that suddenly feels painfully outdated. Every month, like clockwork, $500 leaves his checking account and gets automatically invested into a simple three-fund portfolio. Mostly VTI, which is Vanguard's total stock market index fund, some international exposure through VXUS, and a small bond allocation through BND. It's the most boring, textbook, conventional strategy imaginable, the kind of thing a financial advisor would recommend to your grandmother. Jake didn't come up with this strategy in a vacuum. He'd spent months researching, reading books like The Simple Path to Wealth and A Random Walk Down Wall Street, understanding the historical data showing that passive index investing beats active trading for the vast majority of investors over the long term. He'd made a plan, committed to it, and was steadily executing. But in 2021, that plan started to feel like bringing a knife to a gunfight. His friends had different approaches. There was Marcus, who'd discovered day trading during the pandemic lockdowns. Marcus had turned his spare bedroom into a trading station with 3 monitors, subscriptions to premium charting software, and a Discord group where traders shared plays in real time. Marcus was talking about quitting his job because he'd made more money trading in 6 months than his salary paid in a year. Then there was Sarah, who'd gotten into cryptocurrency early and was riding the wave up. She'd bought Ethereum at $1,800 and watched it climb past $4,000. She'd thrown money at various altcoins, some of which had done 10 times, 20 times returns. Sarah was planning an early retirement at 35. And there was David, the most aggressive of the group, who was playing with options, leveraging trades, and making increasingly complex bets on market movements. David had turned $20,000 into $90,000 in less than 8 months. He was convinced he'd figured out the game. All of them were in Jake's close friend group. They'd have dinner together, hang out on weekends, and increasingly the conversation always turned to investing. And Jake, with his boring $500 a month into index funds, started to feel like the odd one out. The comments started subtle, but grew sharper over time. It began with genuine concern. Marcus would say things like, "Man, you're really just doing index funds? You know the market's changed, right? The old strategies don't work anymore." There was this assumption that Jake simply didn't understand what was happening, that he was stuck in outdated thinking. Then it evolved into friendly teasing. At a barbecue, David pulled up his brokerage app and showed everyone a trade he'd made that morning. $4,000 gain in 6 hours. Everyone crowded around, impressed and excited. Someone asked Jake what he was trading. "Nothing," Jake said. "I just buy index funds monthly." The group went quiet for a second, then someone laughed. "Come on, seriously, what are you actually doing?" They couldn't quite believe that Jake was sitting out the biggest wealth creation opportunity of their generation. By mid-2021, the mockery had teeth. Sarah, after another successful crypto trade, looked at Jake over dinner and said, "I just don't get it. You're watching all of us make actual life-changing money, and you're okay with your 7% annual returns. Like, that's not even beating inflation anymore. You're basically going backwards." The implication was clear. Jake wasn't being smart or disciplined. He was being scared and missing out. The group chat became harder to be part of. Every day brought new screenshots, gain after gain after gain. Marcus posted a picture of his new BMW, paid for entirely with trading profits. David shared that he'd made enough to pay off his student loans completely. Sarah was looking at investment properties because her crypto gains were so substantial she needed to diversify. And Jake, every month, was putting his $500 into VTI and watching it grow at what felt like a glacial pace in comparison. The psychological pressure was immense. It wasn't just about the money. It was about feeling left behind. feeling stupid for following conventional wisdom when everyone else had figured out a better way. Jake would lie awake at night, second-guessing everything. Had the rules really changed? Was he being stubborn about a strategy that no longer worked? Had he become the investment equivalent of someone insisting on using a flip phone when everyone else had smartphones? His friends weren't trying to be cruel. They genuinely believed they'd figured something out and wanted Jake to benefit too. Marcus offered to teach Jake his day trading system. Sarah sent him links to crypto exchanges and tutorials. David explained option strategies over coffee, drawing diagrams on napkins. They were trying to help, which somehow made it worse because their help came with an underlying message that what Jake was doing was wrong. There were moments when Jake almost broke. One particularly brutal day, he sat down and calculated what would have happened if he'd taken the $20,000 he'd put into index funds over the past 18 months and put it into Ethereum instead. The number made him feel physically sick. He would have had over $60,000. Instead, he had about $23,000. The opportunity cost felt staggering. He started watching YouTube videos about crypto. He opened a Coinbase account and let it sit there empty while he debated making a deposit. He read articles about the next big cryptocurrency that was going to replicate Bitcoin's returns. He looked at his automatic investment schedule and hovered his mouse over the cancel button multiple times. The most tempting moment came in October 2021. Marcus invited Jake to join a new trading group he was part of. They had a track record, Marcus explained, of identifying plays that consistently returned 20 to 40% in a matter of weeks. The entry cost was $2,000, which seemed steep, but Marcus assured him it would pay for itself in the first month. "Look," Marcus said, "I know you like your safe approach, but this is basically free money. We're not gambling, we've got systems, we've got data. You'd be crazy not to at least try it." Jake came close to saying yes. He had the $2,000. He trusted Marcus, who was genuinely making money, and he was tired of feeling like the only person not invited to the party. That night, he drafted a message to Marcus saying he was in, but he didn't send it. Instead, he went back and reread his original investment thesis. He reviewed the data on active versus passive investing. He looked at the stories of the small percentage of traders who made it big versus the vast majority who didn't. He reminded himself that what he was seeing was survivorship bias, that for every Marcus and Sarah and David, there were dozens of people losing money quietly, not posting about it in the group chat. Most importantly, he thought about his goals. He wasn't trying to get rich quick. He was trying to build lasting wealth over 30 years. He was optimizing for consistency, not excitement. His strategy was boring because boring works when compounded over decades. The flashy strategies his friends were using worked right up until they didn't, and when they failed catastrophically. Jake deleted the unsent message. He kept his automatic investments running, and he accepted that he was going to feel like an idiot for a while longer. The turning point started small and easy to miss. It was January 2022, and David mentioned in passing that he'd had a rough week in the market. Nothing major, he said, just gave back some of his gains. The group didn't think much of it. Markets go up and down, everyone knows that. David had been up so much that a small pullback seemed irrelevant, but the pullbacks kept coming. Technology stocks started declining. Crypto, which had seemed invincible, began a slow, grinding descent. The Federal Reserve announced it was raising interest rates to combat inflation, and suddenly the free money environment that had fueled so much of the speculation was ending. Marcus was still confident. He'd been through pullbacks before, he said. This was just a healthy correction, a chance to buy the dip. He showed the group his screens where he was entering new positions, convinced the market was about to bounce. Sarah agreed. She'd seen Bitcoin go through multiple cycles. This was just another one. She was holding, even buying more. David was quieter than usual, but maintained his positions were fine. Options were tricky, he explained, and he'd had some positions expire worthless, but overall, he was still way up from where he started. Jake noticed that David had stopped sharing his account balance, but no one else seemed to pick up on it. For Jake, something interesting was happening. His boring index funds, which had felt painfully slow during the upswing, were now falling too, but at a much more moderate pace. While crypto was down 40, 50, 60% from its peaks, his portfolio was down maybe 15%. While David's complex options positions were evaporating, Jake's simple stock holdings were just experiencing normal market volatility, and here was the crucial part. Jake's automatic investments kept buying, every month $500. When the market was down 15%, his $500 bought 15% more shares. When it dropped another 10%, he bought even more. It was dollar cost averaging in action, the strategy that sounds boring in bull markets but reveals its power in downturns. His friends had stopped buying. Marcus couldn't buy more because he was trying to preserve capital, waiting for the right moment to get back in. Sarah had stopped adding to her crypto positions because she was worried about catching a falling knife. David was paralyzed, unable to trade because his option strategies required market momentum and there was none. Jake was the only one still accumulating, month after month, buying when no one else wanted to, building positions when assets were on sale. And while his account balance was going down in the short term, the number of shares he owned was climbing faster than ever. By mid-2022, the group chat had changed dramatically. The daily screenshots stopped, the celebration posts disappeared, the conversations about early retirement and new cars faded away. When they met up in person, investing was no longer the dominant topic. It was as if everyone had collectively agreed not to discuss it anymore. Jake didn't ask what was happening, but he knew. Marcus had mentioned his trading account was basically flat for the year, which was trader speak for "I've lost a lot of money." Sarah's crypto portfolio, which had been worth close to $200,000 at its peak, was now worth less than $70,000. She didn't say this directly, but Jake could piece it together from comments she made about unrealized losses and holding for the next cycle. David was the one who worried Jake the most. David had stopped coming to group hangouts. When Jake reached out privately, David admitted he'd lost most of his gains and was dealing with some debt from margin calls he didn't fully understand when he took the positions. He'd gone from $90,000 back down to his original $20,000, and because he'd been trading in a taxable account, he now owed taxes on gains he no longer had. David was working overtime to cover the tax bill. The worst part was the silence around the losses. If gaining money had been something to share and celebrate, losing it was deeply private and shameful. None of them wanted to admit how much they'd given back. There's a psychological phenomenon where people share their wins but hide their losses, which creates a false impression that everyone else is doing better than they are. Jake was watching this happen in real time. Meanwhile, Jake's account had done something interesting. After dropping to around $19,000 in June 2022, a low point that had tested his resolve, it had started recovering. By September, he was back to $22,000. By December, $25,000. He'd continued his $500 monthly investments through the entire downturn, and those purchases made at lower prices were now appreciating as the market found its footing. He wasn't bragging about this. In fact, he barely mentioned his investments anymore because he saw how sensitive the topic had become. But internally, something had shifted. The doubt that had plagued him in 2021 was gone. He'd watched his strategy perform exactly as historical data suggested it would. Boring during the boom, resilient during the bust, steady over the full cycle. It started with Sarah. They were having coffee in early 2023, just the two of them, when she asked, "So how's your index fund thing going?" There was no mockery in her voice anymore, just genuine curiosity. Jake gave her the honest numbers. He'd invested about $30,000 total over 3 years. His account was now worth $38,000. Not spectacular, but solid, consistent. Sarah nodded slowly. "I think I need to change my strategy," she said quietly. "I'm still down over 60% from where I was, and I don't know if crypto's ever coming back to those highs. I've been holding because I don't want to realize the loss. But I'm starting to think that's just pride." She asked Jake to explain his approach again, this time taking notes on her phone. Then Marcus reached out. He wanted to talk about trading, he said, but when they met up, the conversation was different. Marcus explained that he'd burned out. The constant monitoring, the stress of every market movement, the wins followed by devastating losses, it had taken a psychological toll he hadn't anticipated. "I thought I was good at this," Marcus admitted. "I had some wins and convinced myself I'd figured out an edge. But looking back at my full track record, I've made some money, but nothing close to what I would have made if I'd just held SPY." SPY is the S&P 500 index fund. "I'm thinking about going passive," Marcus said. "Can you walk me through what you do?" David took the longest to come around, and when he did, it wasn't triumphant. They met for dinner, and David looked exhausted. "I'm out of the market completely," he confessed. "I can't handle the stress anymore. Lost too much, owe too much. I'm just working and paying down debt right now." He paused. "You were right, about keeping it simple, about not trying to get rich quick. I wish I'd listened." Jake didn't feel vindicated hearing this. These were his friends and they were hurting. The money they'd lost represented years of work, sacrificed experiences, delayed life plans. There was no satisfaction in being right when people you cared about were wrong in such painful ways, but there was a lesson materializing that Jake knew he needed to help them understand. The lesson wasn't about Jake being smarter, it was about Jake having chosen a strategy that removed his ability to make emotional decisions. His automatic investments meant he couldn't panic sell during downturns or get greedy and over-concentrate during booms. The system protected him from himself. What happened to Jake and his friends is not unique. It's a pattern that repeats in every market cycle with remarkable consistency. During bull markets, especially prolonged ones, conservative investing strategies look foolish. The people making safe, steady progress get lapped by risk takers who go all in on whatever's working at the moment. History is full of these examples. In the late 1990s, it was day traders making fortunes on tech stocks while index fund investors looked like they were missing the internet revolution. In the mid-2000s, it was house flippers and real estate speculators getting rich while renters and conservative buyers seemed to be missing out. In 2017, it was the original crypto boom. Then 2021 brought another wave with meme stocks and NFTs. Every single time, the narrative is the same. This time is different. The rules have changed. The old strategies don't work anymore. You're being left behind if you don't adapt. And every single time the speculative bubble bursts, the risk takers give back most or all of their gains, and the boring investors who stuck to fundamentals end up ahead over the full cycle. The data on this is overwhelming. Studies consistently show that somewhere between 80 to 95% of active traders underperform simple index fund investing over 10-year periods. The majority of individual day traders lose money. Most cryptocurrency investors who tried to trade rather than hold major coins ended up with losses. These aren't controversial statements, they're documented facts, but knowing the data and acting on it during a speculative mania are two completely different things. When everyone around you is making money and you're not, the data feels abstract. The FOMO, the fear of missing out, is a powerful psychological force. It takes genuine discipline and emotional maturity to stick to a boring strategy when exciting alternatives are available and seemingly working for everyone else. Jake's experience highlights something crucial about successful long-term investing. It's not primarily about intelligence or market knowledge, it's about emotional control and process discipline. Jake wasn't smarter than his friends. He probably knew less about markets than Marcus with his charting systems or David with his option strategies. But Jake had a system that removed his emotions from the equation, and that system saved him from himself. By mid-2023, the divergence in outcomes had become stark. Jake's account had crossed $45,000. He'd invested $33,000 total at that point, meaning he was up about 36% on his invested capital. Not earth-shattering, but solid and consistent with historical market returns. Sarah had made a painful decision. She'd sold most of her crypto holdings, realizing substantial losses, and moved the remaining capital into a simple portfolio similar to Jake's. She'd lost about 2 years of progress, but was rebuilding with a more sustainable approach. "I'm bitter about the lost time," she told Jake, "but I'm relieved to not be checking prices every hour anymore." Marcus had also shifted to passive investing, but continued to day trade with a small portion of his account, unable to completely let go of the activity. His results were mixed. The index fund portion was recovering nicely. The trading portion continued to be volatile, sometimes up, often down, mostly just spinning its wheels after fees and taxes. David was still on the sidelines, paying down debt, unable to stomach getting back into markets after his losses. This was perhaps the saddest outcome because David was now missing the recovery, compounding his initial mistakes with a second error of staying out too long. The broader market had entered a recovery phase. Not spectacular, not a straight line up, but a general upward trend. Jake's boring strategy was doing what it always does in recoveries, quietly compounding, benefiting from the shares he'd accumulated at lower prices, requiring no active management or difficult decisions. The most striking thing was how the group dynamic had completely reversed. In 2021, Jake had been the outlier, the one doing it wrong. In 2023, Jake's approach had become the reference point. People asked him questions. They wanted to understand his thinking. The mockery had transformed into respect, not because Jake had changed his strategy, but because time had validated what historical data always suggested would happen. There's a harsh reality in investing that reveals itself over full cycles. Short-term results are largely noise and luck. Long-term results are mostly strategy and discipline. Jake's friends had mistaken noise for skill during the 2021 boom. They'd attributed their gains to their intelligence and superior strategy when in reality, they were mostly benefiting from a rising tide lifting all boats, especially the riskiest ones. When the tide went out, to paraphrase Warren Buffett, it revealed who was swimming naked. The complex strategies, the active trading, the concentration in speculative assets, all of it fell apart under pressure. Meanwhile, the simple strategy, the boring strategy, the strategy that required no special skill or market timing, just kept working. What's often not discussed in investment stories is the lasting psychological impact of major losses. David's case is particularly instructive here. Even as markets recovered in 2023 and 2024, David couldn't bring himself to invest again. He'd been so burned by his experience with options trading that he'd developed what psychologists call financial trauma. Every time he thought about investing, he'd remember the sick feeling of watching his account value collapse. He'd recall the margin call he didn't understand, the tax bill on money he no longer had, the months of extra work needed to dig out of the hole he'd created. The pain of those memories was more powerful than any rational argument about why investing in diversified index funds was different from what he'd done before. This is a hidden cost of speculative investing that rarely gets discussed. When people lose money gambling on risky trades, it doesn't just set them back financially, it can damage their relationship with investing altogether, causing them to miss out on years of compound growth because they're too scared to participate in markets at all. Marcus faced a different psychological challenge. He'd built part of his identity around being a trader, someone who was actively engaged with markets, making decisions, exercising skill. Shifting to passive investing felt like giving up, like admitting he wasn't as smart as he thought he was. Even though he intellectually understood that passive investing was likely to serve him better, emotionally he struggled with the transition. Sarah's journey was perhaps the healthiest of the three. She'd acknowledged her mistake, taken her lumps, learned from the experience, and moved forward with a better strategy. But even she admitted that seeing her account balance had become triggering. That number that once represented potential early retirement now reminded her of what she'd lost. Jake, meanwhile, had his own psychological work to do. He'd been right about his strategy, but he had to be careful not to let that validation turn into overconfidence. The market hadn't rewarded him because he was smarter. It had rewarded him because he'd chosen a strategy with better odds and stuck to it through difficulty. That's worth understanding, but not worth getting arrogant about. 3 years after the peak of the speculation, the lessons from this experience crystallized into principles worth understanding for anyone building long-term wealth. First, complexity is not an edge. Most of the strategies Jake's friends employed were complicated. Day trading with technical analysis, cryptocurrency with blockchain technology, options with complex derivatives math. The complexity made them feel sophisticated, but it didn't actually improve their results. Jake's strategy was simple enough to explain in 2 minutes, and it outperformed all of them. Second, activity is not the same as productivity in investing. Marcus spent hours every day analyzing charts, reading market news, and executing trades. Jake spent maybe 30 minutes per month reviewing his accounts. Marcus's activity felt productive, felt like he was working toward his financial goals. But Jake's minimal involvement produced better results with less stress and time commitment. Third, volatility works both ways, and the downside is often worse than the upside is good. Jake's friends experienced massive volatility in their portfolios, huge gains followed by devastating losses. The psychological impact of that volatility, the stress and anxiety it created, wasn't worth whatever extra returns they managed to capture temporarily. Jake's steadier path was not just more profitable in the end, it was more livable along the way. Fourth, the ability to stay in the game matters more than maximizing every opportunity. David had to completely leave the market after his losses. That meant he missed the entire recovery. Jake, because he never overextended himself, never faced forced selling, never had to step away. He was present for every up day and down day, which meant he got the full benefit of the market's long-term upward trend. Fifth, the market rewards patience in ways that are hard to internalize when you're in the middle of a speculative boom. The returns Jake earned weren't sexy or exciting. 7 to 12% annually doesn't make for great cocktail party stories. But compounded over decades, those boring returns build substantial wealth. The spectacular returns Jake's friends chased were mostly unsustainable and therefore meaningless in the long run. Sixth, the people making money loudly are often not representative of the average outcome. For every person posting massive gains in the group chat, there were 10 people losing money silently. Jake's friends were part of the small minority who actually made money during the boom, yet even they gave it all back. The true average outcome for active traders and speculators is significantly worse than what was visible in the social proof Jake was seeing. Seventh, having a system that removes emotional decision-making is worth more than market knowledge. Jake's automatic investments meant he couldn't panic sell or greed buy. He couldn't make emotional mistakes because his system didn't allow for real-time decisions. This constraint was his greatest asset. Finally, the social and psychological pressure to deviate from a sound strategy during booms is intense and should not be underestimated. Jake came very close to abandoning his plan multiple times. The mockery, the FOMO, the feeling of being left behind, these are powerful forces. Succeeding at long-term investing isn't just about choosing the right strategy. It's about having the conviction and support system to stick with that strategy when everything around you is screaming that you're wrong. So where does this leave us? It's now late 2025, nearly 4 years since the peak of the speculation. Jake's account has crossed $60,000 on about $40,000 invested. He's on track to have several $100,000 by the time he retires, assuming he maintains his current contribution rate and gets average market returns. Sarah is rebuilding, down from her peak but on a sustainable path. Marcus is doing okay, though he'd be doing better if he'd stopped trading entirely. David is slowly getting back into the market, finally having processed his losses enough to take another chance on investing. The story isn't over for any of them. Markets will boom again, speculation will return under different names, and the same psychological pressures will re-emerge. The question is whether the lessons from this cycle will stick when the next one arrives. For Jake, the experience solidified something fundamental. Investing isn't about being the smartest person or finding the secret strategy no one else knows about. It's about having a sensible plan, understanding the data behind why it works, and possessing the discipline to execute it regardless of what everyone around you is doing. The boring strategy won, not because boring is inherently superior in some moral sense, but because boring tends to mean simple, diversified, low cost, and long-term focused. Those characteristics are what the data shows work over full market cycles. Everything else is noise, entertainment, and usually expensive lessons. If there's one thing Jake would want people to take from his experience, it's this. When everyone around you seems to be getting rich quick and you're making steady, unspectacular progress, you're probably doing it right. The hardest part of investing isn't the technical knowledge. It's having the courage to be boring when boring looks like losing, because boring given enough time almost always wins. Welcome to Harper Mumbling, where we talk about the patient path to building wealth. If this story resonated with you, if you felt the pressure to abandon your plan because everyone else seems to be winning, take a moment right now and hit that like button. Subscribe to this channel because we're going to keep sharing real stories about real investing without the hype and without the shortcuts that don't actually work. Turn on notifications so you don't miss future videos. And most importantly, leave a comment below sharing your own experience with FOMO in investing. Have you stuck to your plan or did you deviate? What happened? Let's build a community of patient investors who support each other through the noise. Share this video with someone who needs to hear that boring is okay, that steady wins the race, that they're not missing out by staying disciplined. Thank you for watching, and remember, the best investment strategy is the one you can stick with for decades, not the one that promises riches tomorrow.